Hello, everyone. Good afternoon. Thank you so much for being with us. And a warm welcome to everyone who's in the room. We have a packed audience, as well as those who are live streaming and in our overflow room. My name is Maggie Lake. I'm going to be your moderator today, and we have a fantastic discussion in store for all of you on the power of partnerships, mobilizing finance and unlocking private sector solutions, something that's so important, as many of you know. To begin with and kick things off for this session, I have the pleasure of introducing the new World Bank Group President, David Malpass. Many of you may recognize his name. He's had a long and distinguished career in both government and in global banking. So if you could please give me a warm round of applause for World Group President David Malpass.
Thank you very much. This is about the 8th meeting of the day, and I didn't know I was supposed to come up, but it's very nice to be back at IFC. I've had the good chance over the last week. I've been in the new job for 3 days, and so I've been to IFC, and it's an important part of the World Bank Group. Creating an environment for private investment is a huge challenge, but it's absolutely critical to alleviating poverty and advancing shared prosperity, the goals of the World Bank. So thank you all for being here today and taking an interest and being involved in this important endeavor. One of the keys to creating that environment is the theme of this event, forming strong partnerships with the private sector and managing those partnerships as well. We're facing, and I want to read a few statistics, we're facing enormous challenges. More than 700 million people still live in extreme poverty. More than 1 billion people still live without electricity. 400 million people lack access to health services. 1 billion people live more than 2 kilometers from an all-weather road. 4 billion people do not have access to the internet. And global infrastructure needs, if you add up some of those and others, amount to $97 trillion by 2040. The public sector obviously cannot provide enough financing to close all of those gaps and to fund countries' development priorities. We must create the conditions to crowd in the private sector. We're working across the World Bank Group to transform entire sectors, investing in agriculture, energy, transportation, and other areas using the cascade approach. That means using scarce public resources to leverage private sector solutions. I supported this approach as part of the capital package that was worked on in 2018. And I'm happy to see that the World Bank Group is moving quickly to make it a reality. Here are some recent examples of how the cascade has worked in the last few years. In Egypt, the bank group mobilized private sector financing to build the Binban solar park and transform the country's energy sector. IBRD supported energy sector reforms with a $3 billion loan. MIGA provided $210 million worth of political risk insurance, and IFC mobilized a consortium of 9 international banks and worked with other lenders to mobilize $2 billion in private investments. Economic reforms freed up fiscal space, doubling social protection for the poorest 20% of Egyptians. The solar park will be the world's largest solar installation, 32 power plants once it's complete. You will see a video of this initiative shortly. And another example is in Cameroon. Each arm of the bank group played a role in the Nachtigal Power Project, a 420 megawatt hydropower project on the Sanaga River. The bank and MIGA together provided guarantees worth 450 million euros, which was crucial in crowding in international capital and providing political risk insurance. IFC committed 110 million euros for its own account and provided from its own for its own account and provided 300 million euros interest rate swap and led a group of 11 developed DFIs and 4 commercial banks to mobilize more than 900 million euros, completing the financing of the project. Nachtigal will increase installed power generation in Cameroon by nearly 1/3, serving up to 5 million people. The project will also create 1,300 direct jobs and up to 27,000 jobs in the broader economy, and it will avoid around 1 million tons of CO2 emissions. These are 2 examples of how we are operationalizing the cascade across the bank group to maximize finance for development. But our ambitions are greater than that. We want to spread this breakthrough throughout the financial community. We think a set of principles is an important start. Just 3 hours ago in the World Bank atrium, 60 investors and development finance institutions adopted the first ever operating principles for impact investing. I hope you've all seen the report. There's a nice report on the principles of impact investing. This brings impact investing into the mainstream by bringing credibility to the, quote, impact part of investments. For the first time, we have a transparent definition of impact and standards to monitor whether projects will bring opportunities and jobs to the poorest communities and promote development that benefits the environment. The discussion today will illustrate how the World Bank Group is working to advance these operating principles for impact management by working with long-term partners, and how we are supporting governments to create an enabling environment, reform sectors, and unlock constraints to private sector investment. We will also hear about how to design environmental, social, fiscal, and good governance standards, which are an integral part of structuring these partnerships with the private sector. Thank you again for the warm welcome for me and for being here. I look forward to working with you to harness this powerful approach to boost growth, alleviate poverty, and advance shared prosperity everywhere in the world. Thank you very much. And now,
You sit next to me. Yep. Okay. I want to make sure we have our correct seats. Hi, everyone. Again, good afternoon. Thank you so much for being with us. A couple of housekeeping issues to get through before I introduce our fantastic panel. This event, as I mentioned, we have all of you in the room. It's also live streaming at World Bank Live for any of you who have colleagues who may not have been able to get in the room. And at the end, we hope to be able to take some questions if time allows. So please, you will find cards on your seat. You can write them on that. And then, again, if you're not in the room or if you're watching or in an overflow room, hashtag FIN, F-I-N, the number 4 DEV, FIN 4 DEV. You can send your questions to that as well. And again, we will try to get them in. We will be taking questions online through that hashtag. And of course, please silence your phones if you haven't done so already. Thank you so much. So let's introduce, again, we're talking about private partnerships, the power of partnerships, mobilizing finance, and unlocking the private sector solutions. As David Malpass just talked about, its importance. And so let me introduce our fantastic panel today. We're going to have a great discussion. And we thank you all so much for your hard work in this area and for being with us today. And I'm going to go down the row this way. Next to me, Ahmed Shideh, Minister of Finance of Ethiopia. Next to him, we have Philippe Leouarou, the CEO of the IFC and our gracious host today. Nadia Calvino, Minister of Business and Economy for Spain. We have Hiro Mizuno, Executive Managing Director and CIO of Government Pension Investment Fund. We have Lucy Heinz, Partner of Actis, and Marissa Drew, CEO, Impact Advisory and Finance Department of Credit Suisse. So thank you all so much for being with us today. I would like to, Philippe, start with you. We know that the need is so great, but could you talk about the importance of this approach for us?
Well, thank you. Thank you very much, and welcome everybody to the IFC. For us, why is it important to go to this cascade approach? We have done for 62 years in IFC kind of financing private investors that used to come to us and say, okay, we have an investment in this country, and then we had a number of filters. You know, it's not drugs, it's not weapons, it's not this, and then you go to the structuring of the deal, because we have been for 62 years trying to combine three things. One is financial sustainability. Otherwise, that's base one if you think about baseball, first base. You need financial sustainability of the company with finance, because if they're bankrupt, there is no impact, which leads me to the second base, development impact. We have been created to show that we can both make profit and have impact. That's where we're created in 56. And the third base is additionality. Why do finance what the private sector can finance itself, or the private banking sector or other financial institutions? So these are the three bases. Now, we have been doing and being very successful. The key issue now is we have always been pushed along history to go to the toughest and toughest places. And now we want to do much more in the poorest countries and much more even in fragile states. And that's tough. That's very tough. So how do you do it? Because what we have witnessed, we did ramp up very quickly in Africa. But for the last decade, we have stagnated at about 3 billion a year. Now, how do you go to the next level? And I keep asking my staff, I keep asking other colleagues. We all say the same thing: there is not enough bankable projects. So if you don't have bankable projects, create them, invent them. But for that, it's also not that easy. We need to start working a bit differently, which means to work upstream. Because if you just finance the project, you wait for the investor to come to you. Now it's the other way around. We're turning the table. And we have a very good example that on scaling solar, that is one of my favorites. I mean, you saw the one in Egypt.
Yes.
But in Zambia, we did something like that. But what does it mean? It means working with the government upstream. Say, can we find a piece of land to put the solar panel for? Then we arrange finding land is not that easy in many countries. Then we worked with our colleagues from the World Bank, because then the risk is what? You put the panel, you sell the electricity, but you sell it and you take a huge risk. So how do you de-risk that? We went to the World Bank, they gave a guarantee on the power purchasing agreement. And then we auctioned the project by saying that IFC will be there anyway to finance and structure the project. That meant that for investors that had no intention to set foot in Lusaka, to look at it all of a sudden, because there's no risk. There is risk, but it's a risk that they can control. It's a risk of the construction, which is their risk, it's a project risk, but it's not the risk on the fiscal strength of the country, because the bank was there. There's no risk to not find a piece of land, and it's, as I say, it can take a lot of time to find a piece of land, and you have the financing insured. All of a sudden, we crowded in investors that had no intention to come to Zambia, and they came out and they competed, and that's very important, compete, auction. And the outcome is we came out with 4.5 cents a kilowatt hour, where the rest in Zambia is about 20 cents a kilowatt hour. So this is a win-win-win. You make a profit, you have a big impact, it's clean, it's more electricity, which means more economic activity. So I'm sorry I want to illustrate, because otherwise it's very quickly, very theoretical. So that's, and we replicate that now among, in many other countries. We're in Senegal, we're in Madagascar. We hope that will be in Ethiopia soon. We are in.
He says with a.
In
So
East Asia.
I think what's so important about this panel is that we have represented the government as well as the private sector. So we can drill down a little bit in this now that you've sort of set the stage of what's different and the framework you're hoping to operate on. So let's start on the government side of this, since he just said he hopes to be in Ethiopia. Tell us from your perspective. What would this look like in Ethiopia? How are you looking to the private sector to try to meet some of your needs?
Thank you, Maggie. Thank you, Philip, and our colleagues. Particularly, Ethiopia is one of the largest countries in the Horn of Africa, with more than 100 million population, and we had also impressive growth for the last 10, 12 years. Recently, we are embarked on a comprehensive reform program. At the heart of that reform program is to unleash the role of the private sector. Therefore, maximizing finance for development approach, which is championed by World Bank and AFC, is a very important welcome for us. In fact, it is at the heart of our transformative reform agenda, which Ethiopia is undergoing. We have been investing a lot on infrastructure, on human development, on institution building, with a strong focus on growth and development, mainly involving public sector resources. And now we are rebalancing that one. We need to sustain growth and development. Therefore, we are rebalancing from using state investment to more now attracting private investment, both in infrastructure, in other strategic, industrial, and other all economic activities. Therefore, we are going to rely more now on private sector. That's why we are introducing a comprehensive reform of privatization to attract investment into already existing infrastructure project which government has already invested on, but we are also working on private-public partnership framework, where we are going to work to attract investment into various projects and logistics and energy and transport and railway and other sectors. We are working with Philip and IFC in terms of scaling solar, which is going to be one of the first kinds of private sector investment into solar project. We are at the stage of project development, and through the support of IFCs in terms of packaging, de-risking with MEGA, and therefore this is the best way to combine private investment, international development financial institutions, facilitating and packaging all this, and government is also partially sharing the risk, and therefore I think this is the power of partnerships in terms of leveraging the potentials of the private sector, and we would like to acknowledge IFC's support and encouragement on this. World Bank and DFID, as well as also African Development Bank, are working with us on this area. So the fundamental objective is to sustain growth and development, to create jobs. We need to attract a lot of investment from abroad. That's why we are transforming the regulatory framework and ease of doing business, and also allowing a sector which was closed to foreign investment is now open for investment and for competition as well. Therefore, Ethiopia is going to unleash the potentials of international private sector engagement in its development to sustain and create jobs and also transform economic structure of the economy. Thank you.
Minister Calvino, I'd like you to pick up on that as well. I'm hearing both from Philippe and from Minister Shadeh the importance of working upstream, of reform, of thinking about all of these things from the beginning now.
Yes, when I was listening to the previous speakers, but also reading the documents that you circulated before coming, I was reflecting on an interesting feature, which is that it's not money that's the problem here. There's plenty of money around. What we need is to make sure that whatever investment is having an impact. And that means you need to focus and you need to shape and to be very targeted on these. And I was thinking that to a certain extent, Spain is a good example of progress in that regard, because we've moved from maybe $400 per capita beginning of the 70s to 20, I was noting it down, 28,000 today, which is incredible progress. And this has been done mainly through public-private partnerships. I wouldn't have called it that way probably, but when you look at it, there's been a significant amount of foreign direct investment coming into our country, very significant structural reforms that have allowed the economy to make this progress and to transform itself. And just 3 brief points on this. One is the importance of institutions. I mean, you need markets to function, and you see a desert, you see a market. Well, I see well-functioning institutions, or else this is not going to be productive at the end of the day. No, it will not last more than the initial investment. You need well-functioning institutions. You need the ownership of the local governments, as the minister was just saying now. The second point is the role of multilateral financial institutions working together. This reflection taking place on this side of the Atlantic is very similar to the same reflection that's taken place over in Europe, with the EU trying to see how to have more impact from the foreign direct investment plan in third countries, but also internally, how to mobilize investment within the Union. And then the third reflection is, and I was very pleased to see the video, is that beyond the short-term market and investment orientation, you need also mid-term sustainability, which requires you to think about environmental standards, social standards. One of the key strengths of any country, and I see it every day in my country, one of the key strengths is having strong social tissue, legal certainty, an environment which is going to favor investment because it is stable. I think that's the best way, probably, best word to describe it. And for that, you need to think about this midterm sustainability and not only the short-term issues which may be surrounding the initial investment on the ground.
So I'd love to hear from the private sector to pick up on that as you're looking at these projects. We heard the need for the public-private partnership, but well-operating institutions. Walk us through the thought process as you approach these projects. And Hira, we can start with you.
Well, thank you.
I think you have to turn on.
First of all, it's great to be in this IFC building. GPEF has a long-term working partnership with IRC. We are anchor investor in your emerging market private equity fund of funds. And also, we have a great working partnership, strategic partnership with the World Bank Group. We have been working on how to mainstream ESG into a bond investment over the last 2 years. And we recently announced a new initiative to facilitate more flow of capital into green bond market. So I appreciate all your, the partnership and, great initiative made by World Bank Group. For us, the sustainable development goal is something, if we fail to achieve, we are going to face serious systemic risk for our portfolio. Because the GPEF manages $1.6 trillion, and our investment time horizon is 25 years assumed. So if we don't achieve sustainable development goals, there are a lot of risks I can very easily imagine will damage our portfolio. So from that perspective, that's very important. So we are very serious in promoting sustainability in our investment strategy. And we hear a lot of excitement about impact investment principle, green bond, etc. But And I also heard several times that the capital is not a problem because there's so much capital around that everybody say we want to invest, bring us some opportunities. But I actually think you probably should discount that comment a little bit, because when you talk to the investors, ask what they mean by investable product, they probably answer, we are looking for the project which has very low risk and very high return.
Shocking to hear that from the private sector, I know.
It's a fantasy. And then, we have been investing in private equity in an emerging market together with IFC. But reality is the performance or return we have been enjoying is actually very comparable to what we can get from US private equity. So to make those capital real, we need to work on either on a return to make it higher, because it doesn't make much sense for investors to accept the same level of return from emerging market compared to the developed market. Or we need to have somebody like a World Bank Group, a MEAGER, to help to create a structure to reduce the risk. And also we need the local government to consider that's what the investor needs. So I think we need to work much harder to make investable product really investable. And from my perspective, once private sector really find the opportunities, they will become more creative. I think so far I see very little creativity coming from private sector. And since GPIF has been advocating very, very seriously about integration, importance of ESG, none of the asset manager CEO tell me they don't consider ESG into their investment decision. But I'm really skeptical in reality how they are doing it. And a green bond is very fashionable. And we just started a new initiative with the World Bank. But green bond itself is growing, but it's still less than 1% of the global fixed income market. So it's still fringe, not the mainstream investment product. So we have been focusing on, letting the other asset manager work on a little bit more like impactful or colorful things. We are focusing on how to move the mainstream, hardcore investment professional to become active in this, like a sustainable, investment opportunities. So we have been working very seriously and very closely with the index providers, because now the majority of equity market is managed passively. So we need to make the index provider serious about ESG integration. And then also, when we started thinking about how to promote the green bond, it's easier for us to just hire somebody like this, the asset manager who was, enthusiastic about green bond investment. But we actually instead decided to make our passive manager to buy green bond. So to do that, we need to change our investment guideline, and we allow the passive manager to go off benchmark to buy the green bond issued by World Bank Group, which is very unusual. But by doing that, and also we redefined our definition of ESG integration to be, it's a systemic inclusion of ESG factors in investment analysis and investment decision. Because we heard a lot of asset managers say, they integrate ESG into their analysis, but if they don't integrate that in investment decision, what's the point? So we made it very clear, and we followed that by saying we regard investment into the green bond or sustainable bond as a most direct method of ESG integration. And then we announced our partnership with the World Bank Group. And look at what happened just over 1 week. More than $500 million green bond issued by World Bank Group, purchased by our passive managers. So when we redesign the structure or framework they are working, we can actually shift the whole system. And that's what we have been focusing on.
So I would love for Lucy and Marissa to weigh in here too, and give us your thoughts. Do you agree? How do you see this developing? And is there a lack of creativity and an opportunity now as we grow this space to think outside the box?
So I'll pick that up.
It's a great honor to be here. I've never sat next to $1.6 trillion before, so that's pretty exciting too.
We saw a lot of elbows with that number.
I'm really lucky. But I mean, a word on context and about the cascade, and that at Actis we have developed nearly 20 projects in Africa over the last 17 years. We're MIGA's largest client in Africa by the number of projects. And we're currently working very closely with MIGA and IFC on a 250 megawatt wind project in Egypt, which we are really excited to be looking forward to close in July. And the cascade is very important to us. So the importance of sustainability for us, and I hope this is creative, is about risk mitigation and value creation. And it's really around three main pillars, and I think that speaks to what others on the panel have talked about. So commercial sustainability, which is really around investing in least cost, affordable generation. So for example, the tariff in Egypt is 3.82 cents per kilowatt hour, which by global standards is definitely affordable. License to operate, which speaks to social sustainability, particularly around long-term community impact and livelihood enhancement, around jobs, enterprise development and skills. And then lastly, around integrity and transparency. And that's where it's really important to us to partner well, both with IFIs and with the governments in whose electricity sectors we invest. Because at the heart of our philosophy is that we are building projects that are there for 20 to 30 years. And these are long-term projects and long-term partnerships needed around them to support them. If I may just add on the how, because you said that was a need. So in every platform that we invest in, every energy business, we have an ESG director, we have an ESG subcommittee, we have an ESG strategy, we have a long-term community investment plan with an agreed budget, and we also invest in the construction phase, which is important because that's when you're having the most impact on the communities that you're around.
Marissa.
Right, so as a global financial institution, we speak for, just in sustainable strategies, about 25 billion worth of capital that is integrating ESG into its investment practices. And then taking a step further, we have several billion of impact strategies. And these are active strategies where we're placing clients' money to work. But we talked a little bit, I loved Mrs. Calvino's comment that it's not just about money. These days you must create the conditions to facilitate these large pools of capital to flow, and that's where this environmental, social, and governance baseline is absolutely critical. What we hear from our investors, and just to give you a few facts and figures, there's about 30 trillion worth of money in sustainable strategies today, 30 trillion. And basically when we poll the large asset managers, so these are people with running 10 billion or more of capital, over 200 of those types of asset managers are polled, they will tell you that they are moving very rapidly to have at least 50%, and the other half of those people we poll are saying within a few years, 100% of their funds will be in ESG strategies. So pretty soon we're going to be a world where we're not talking about ESG or not ESG, it's just going to be the absolute baseline. And this is where I would like to give a shout out to the minister from Ethiopia, because we Credit Suisse on our own balance sheet, we've underwritten a project which is a north-south railway project, north of $1.5 billion US. And the reason that we are able to underwrite that as Credit Suisse off our own balance sheet and then bring in syndication partners across the broader financial system is because of the progressive and very, very appropriate policies that are taking place in Ethiopia on the reform side. So everything that they're doing in this railway project is meeting the kinds of environmental standards that we hold ourselves to. It is meeting the social standards with the displacement of people and making sure that they're looked after as this railway gets built. And I also have to say, increasingly, our investors and ourselves are looking at diversity. And a big old shout out because 50% of Ethio's cabinet is women. And that is a big deal.
Yes, that deserves a round of applause.
And that's creating those kinds of conditions that make people like us want to underwrite the checks, and then the people that follow us want to participate in these projects. So I'm very proud to be part of that. And I think this is what we mean when we're creating the conditions, and it's not just about the money. And then I want to touch on, if I may, just one other project with that's something that we initiated with the World Bank. And again, when we say it's not always just about money, sometime about a year or so ago, we were kicking around, just sitting in a room, saying, what could we do as a financial services institution that could help the World Bank in its projects, development projects in some of these frontier markets in the world? And the then president said to us, one of the things that really bothers me is that we've got projects in 197 countries, and we know many of these projects would benefit from disruptive technology that exists today. Yet, we have an entire ecosystem sitting in Silicon Valley that doesn't have the risk tolerance or the appetite or the knowledge of how to participate in these markets. So maybe if Credit Suisse could sit in the middle, because we bank all of these folks out of our tech practice, and yet we partner with the World Bank on so many opportunities, what if we could sit in the middle and bridge that gap? And that's exactly what we did. So we created a pool of capital that has had a call out, and I understand that over 200 World Bank projects came forward and said, we would like to participate in this. And we basically defined the type of technology that would be transformational for those projects. And we now are going out, we've selected the ones that should get funded, and we are helping with our capital to do all the hard legwork, to do the feasibility analysis and the scoping and all this sort of thing. That'll allow us to go out to the tech community and say, okay, tech provider, if you have a technology that fits this box, please put in for it, and we are going to create that bridge. And the tech guys are going to love this because it's a whole new market segment that they would have never touched before. And then on the other side, you've got the projects that are going to benefit from this disruptive technology. And I think that's really cool. And this is what we talk about when we're saying the power of some of these partnerships that are thinking outside the box. And I hope, contrary to my panelist over here, I hope you think that's creative, because I sort of do.
I was just going to say that sounds like creative thinking to me. I want to pick up on something, and Minister Calvino and Minister Shadeh, I would like you to talk to this, but let's start with you, Minister Calvino. We talked about the work on the ground, the communities during the construction phase. If we look at pure capital, it often chases returns, but does not always go to those in most need. How can we make sure that this is inclusive, that this does get to the most vulnerable communities? I mean, that will be, in the end, its legitimacy. I know that that's the set goal, but when you're talking about pulling private capital in, how can we make sure that that happens?
Well, I think that's one of the elements that make public-private partnerships interesting, and the role of the multilateral investment and financial institutions more generally important, because it is through this leverage which is provided by the de-risking or pooling of money, or just the coordination of the project and the articulation between the investors and the national government which has these plans. I think that multilateral financial institutions have a key role to play. And in that sense, the World Bank has always had, I think, a very clear focus that this is not just about growth, it is about inclusive, sustainable growth, even more so these days when even private investors are seeing that this is actually an asset and not an additional cost or a liability. And so I would like to finish these remarks with a bit of a more positive tone that we're hearing these days, because there's a lot of gloom around us, slow down, and I think that what we have ahead is huge opportunities, because there is this massive investment that needs to be done to ensure that we face the climate change, that we channel all this energy of climate transition, also social development, social transition, inclusive growth, closing the gender gap. This is going to require massive investments, and now all the planets are in line for this to actually deliver. And the multilateral institutions altogether, also these, the international ones, also the European ones, and national governments, we can all work together to try to put this on the right track.
Mm-hmm. Are you certainly a lot of opportunity? Are you feeling hopeful? What do you make of some of the solutions that we're hearing, and how can they work in your country?
Very hopeful. It's very hopeful, and that is at the heart of our reform agenda, that by not creating additional debt burden and continue only to use public investment, using the power of private sector to finance and develop and involve in various infrastructure activities, will bring significant capacity to our ability to grow. And it also reduces pressure on public finance, which will make us to spend more on other social activities. And using the role of international development institutions, national public resources, to focus on poor development rather than only piling up debt in public investment. So rebalancing will really benefit the poor, and it makes it very inclusive. And the competitiveness and our ability to attract investment will be much enhanced when we use the power of private sector for financing and also to build competitiveness of the economy. That's really important. And sustainable job creation, inclusive job creation, cannot happen without the real involvement of private sector. That's why a comprehensive reform to unleash the potentials of private sector, both domestic and international, and introducing competition, ultimately the whole society will benefit from it. That's why the power of partnership is very fundamental and crucial. International public finance through international development financial institutions, national governments, and private sector working together to deliver infrastructure projects that benefit the poor is very fundamental. And also on market principle basis, it makes it also the financing sustainable. And that will be able to reduce debt burden and also more fiscal room for governments to spend also on other pro-poor activities. Thank you.
And here I see you shaking your head vigorously.
Well, I'm very excited to hear that you're hopeful about the opportunities coming from your the countries. But one thing I just wanted to, if I may, request to those the ministers from these countries, is that I talked about to make the investment into developing countries investable. We need to either improve the return or reduce the risk. And two ways to reduce the risk, which are, one is use somebody like a World Bank group to take some risk away from the project. But the other one, which is actually more powerful, is local government can work to make the project less risky. And then one of the findings from our joint research with the World Bank Group, how to use ESG for the bond investment, proved that ESG is much more relevant for the developing country or lower credit rating issuer. Because it's, your intuition will tell you that, right? That most of the developing countries are more vulnerable to climate risk, climate changes. And the social issues like healthcare, education have been proven by many research, very critical for the economic development. A third one, governance of local government is obviously the key to make investment less risky. So I think that we really cannot just hoping that the World Bank Group can reduce the risk, but we have to depend upon the local government to reduce the growth risk of the project.
I'm going to let Minister Shade respond before I get to
Just to give a concrete example on this one. For example, our work with Philip IFC is that on upscaling the solar project, the national government is partially sharing the risk, and the MIGA is also helping us in terms of some element of risk. And also with the competition will bring reasonable return. And definitely that is the way to make investable. So by working together, international financial institutions, and also technical support from IFC and World Bank in terms of structuring and packaging the whole arrangement will make it more attractive for investment. And that's, in fact, the power of partnerships. As a concrete example, we can mention that one. Thank you.
Okay, Marissa and then Lucy.
And if I can step back just also when we talk about risk and return, there's an element of portfolio theory, which also says diversification is a good thing. And so when I think about the emerging markets and some of these projects, this is diversification away from the developed world, which creates really good portfolio theory adjusted return, because you're in a growth market and you're not competing with the same projects that you have in the rest of your portfolio. And we are increasingly seeing very good, rigorous academic data, which says if you apply just a basic, simple ESG screen on your portfolio of investments, not only do you create outperformance or alpha, which is more acute in emerging markets by percentage points than it is in the developed markets, but it's also a risk mitigation tool. So in times of market volatility, it dampens down the volatility. So again, that's in its own right. I'm just saying as a conceptual asset class matter or direction of travel where you want to invest matter, it's actually just good, smart investing. And then when you have the extra layer of a progressive government partner like Ethiopia, who's willing to share some of that risk, what's not to love? That's why these deals are getting done, and that's why we're seeing more and more appetite for a country like Ethiopia from the private sector.
Just one thing, before we are going to try to get to some questions at the end. Somewhere they're being collected or given. So we'll start to wrap this up. So if you do have any questions, please put them in. Okay, we have them. Yeah, they're on the card, so you can pass the cards somehow up to the front if you do have them. But Lucy, go ahead.
I'd like to just add on the risk point, because I think when you talk about, and picking up on Marissa's point as well, when you talk about a low-cost, affordable tariff, so therefore it's affordable for that government to pay, the power is needed, which I think is a massive differential to the Western world, and that levels of energy access are low. We've talked about the billion people who need to have access to electricity. You think about then a long-term government offtake contract, which is structured well, which has all the right provisions in terms of bankability. Then you wrap that with PRI from MIGA, which is effectively putting a AAA-rated credit behind that government. And you look at that, and then you bring in the IFC and others in terms of DFIs who are there at the table, thinking about the sector, all the leverage that they bring. I think we would argue, and this is my favorite statistic when I'm talking to our investors, is that when you look at, S&P has done a study, and when you look at the default risk on African projects versus North America. The default rate in African projects is 1.4%, and in North America it's around 9%. And I think that really speaks to the fact that, yes, you're looking for higher returns, but once you have this wonderful mix and the cascade and everything, the risk is actually lower. And that's something to think about.
Philippe, I could see you during this entire conversation, so much of this resonating, and you've been patiently
in violent agreement.
Your head. Yes, exactly. But pull it all together for us. And I will say that as part of the media, an occupational hazard is that we spend a lot of time talking about the problems. It is so refreshing for me to hear so much about the solutions that are being put in place. Philippe, what should we take away from this?
Well, there are many takeaways, so that's not a real fair question. But I think the truth is, I mean, I'm a simple man, and I like math. If we are serious about saving the planet, and I like what my President Macron said, there is no plan B because there's no planet B. So, which is true. And if we are serious about development, which is improving human dignity, to be honest, in as many countries as we can, we have established that we need about 4 to 7 trillion a year in additional investment. Now, ODA, official development aid, is 140 billion, not trillion, billion, and flat. Flat, and there's a lot of struggle to remain flat. So that's the billion to trillion agenda of the UN, launched in Addis Ababa in 2015. How do you get that? And talking about Africa, what I see is, okay, debt is going up, public debt is going up, population growth is going up. We need to create 1.7 million new jobs in sub-Saharan Africa every month. So do you want 1.7 million new bureaucrats every month, massive migration, or private sector? So for me, it's not a question of whether, it's how. And the cascade is one way to try to solve it and to change a little bit the model that we've had for 60 years, both in the World Bank and in IFC, to try to leverage each other so that the total is bigger than the sum of the two parts. That's what we try to do. And crowding in, and that's the partnership, as many private sector as we can, crowding in other DFIs so that we row in the same direction instead of wandering this way and the other one the other way. That's why the country platform that Tarman has put on the table is very important, but we have to make it happen, and it's not easy, it's work. And fundamentally, if you think at the World Bank Group, what is a World Bank Group? You can see it, if I'm trying to translate it from the private sector. It's a huge de-risking machine. Because you're right, The first thing is de-risk the country risk. And that's a lot of investment in public education, in health, in rural roads that the private sector will not be able to do, but also to engage on the reforms. You need good laws, implement the laws. So that's kind of de-risking the country. Then you can de-risk sectors by opening up a sector, by making sure that the rule of the game is clear in that sector. And then you can de-risk the project. Mm-hmm. So again, the World Bank Group, frankly, is a de-risking machine, if you think about it. So what we can take about it is let's put this de-risking machine to work better together and crowd in others, both in the private sector that are willing to take the risk with us, mm-hmm. and in other development organizations.
See, he said it was a very hard, unfair question, but of course you answered it fabulously. Yes, exactly. Okay, we have time for just a couple of questions, and that's a mic drop. We're not quite ready for that yet. Before we begin the questions, though, I am going to say that Marissa, who has been so fantastic, has a flight to catch, and we all know what DC traffic is like. So you have 2 minutes. You can listen to the question, but she may get up and leave.
And by the way, on my way to Africa, so I have it's for a good reason.
And we need her to get to that important work. So this is a question so feel free to do that, Marissa, when you need to. This is a question for Minister Shadeh. Ethiopia has started on a credible reform path in recent years, and it's beginning to show results on the power of partnerships, obviously, supporting this. What would be your number one ask of the development community to take Ethiopia to the next level? Your wish list.
I think a comprehensive support for the reform and its consolidation for Ethiopia to consolidate its development gains is very important. That's why we need significant support from our development partners like World Bank and other major development partners from bilateral as well as multilaterals. The consolidation of reform has costs, and we have to address them. We will work hard on our domestic resource mobilization. But again, concessional resource financing for various flexible instruments, budget support instrument is very, very important. And we will count on our development partners' strong willingness to work with us, particularly in the coming 3 years, where we are consolidating. That is not only an investment in Ethiopia, it's also an investment in the region. Peace with Eritrea and strengthened hope in the Horn of Africa is massively embarked on the reform that Ethiopia is now undertaking. And therefore, Horn of Africa, for the first time in its history, now will focus on growth and development, more of regional integration, while addressing also state building, conflict transformation issues. Therefore, I think there is a historic opportunity to enable Ethiopia to move up in its reform effort. In addition to that, harnessing the potentials of the private sector into Ethiopia's development equation is fundamental and very important. Our work with IFC and World Bank in terms of creatively working together in a partnership in terms of managing the risks, as well as making sure that investment is possible in key infrastructure sector is very important. We are working on telecom regulatory framework, logistics regulatory framework, public-private partnership regulatory framework that will able to harness the potentials of the private sector. Therefore, I think international private sector has also a big role to play in Ethiopia's development equation, in addition to domestic private sector. Therefore, the power of partnerships will unlock not only public resources to be used effectively, but it will ignite the engine of growth in the country to create also more jobs. Thank you very much.
Thank you so much. We have some great questions here, but as you can imagine, we're drawing to a close. I certainly think the conversation was well worth bleeding into our Q&A a little bit, but I will let you know that the question and answer period will continue online, so you can go there, post your questions, and hopefully someone will get a chance to respond to you there. So I want to thank our panelists. This was a fantastic, very hopeful discussion, which I've had the pleasure of moderating. Thank you all so much. We're going to have some closing remarks right now as well, but thank you. Thank you. Come on. Just a couple closing remarks. Hang on one second, if you would turn your attention.
Hi, good afternoon. Can I?
Go ahead.
Okay. Good afternoon. Maggie, thank you very much for moderating wonderful panel. I'm Keiko Honda. I'm EVP and CEO of MIGA. Okay, we learned ODA is not enough to fulfill the needs of developing countries. While some of the private investors have innovative solutions and a capacity to fill the gap, I'm very, very happy to hear that from Hiro with $1.6 trillion funds to come up with very creative ways to use World Bank Group to contribute to this. So I'm pretty sure a lot of more creativity and innovation is coming up. Reflecting on the theme of this event, it reminds me of when we first named the MFD or cascade approach a little more than 3 years ago. As a matter of fact, that definition first came out from the kitchen of Philip's apartment, me, Philip, and Kristalina. World Bank Group, since then, worked across departments and agencies to solicit feedback, gather input, and improve on the concept. Because we have learned that what we're missing is not the financing, but rather investable project. This comes from, for example, tariffs not covering cost, regulations not allowing private or foreign private investors to invest in, no clear regulations to govern some industries such as telecom, to name a few examples. Now we implement MFD on a wider scale as one World Bank Group. We can say that this approach is tested and proven. MIGA has over 30 years of track record of bringing private investment into developing markets through mitigating risk, and IFC under the 60+ years through its loans and equity. MIGA and IFC together, combined with the World Bank, over 70 years of development finance, equip the World Bank Group with the experience to help private investors navigate into countries that they might not otherwise consider entering. The Bemban solar project that Philip and I visited earlier this fiscal year, this is actually the world's largest solar park in Egypt. As you also was an excellent example of how all three of us, World Bank, IFC, and MIGA, have worked together to bring innovative solutions at scale. So I want to thank you all, our partners, for sharing our vision to maximize financing for development to achieve the Sustainable Development Goals and the World Bank Group's twin goal, eradicating extreme poverty and boosting shared prosperity. On behalf of the World Bank Group, we look forward to continuing our partnership with every single of you in the future. Thank you for attending today's event. Thank you.